Hello students. So we'll continue with our session. There are some technical glitches which are happening around at the chapter in terms of the IT systems, and unfortunately the live YouTube is unable to project the PPT per se, and at the same time the OBS also is unable to reflect the PPT. So any which ways I am starting off with the session. So yesterday we concluded with the understanding of whole financial statement analysis and the various ratios that are involved in the financial statement analysis. Continuing with the same chapter, I am covering with the short question and answers which were not covered in the previous session, and therefore one by one each short question and answer, what sort of answers should be written and what is the concept that has been covered in a particular short question and answer. Let's see. So the first question, short question, is about capital structure, definition and importance. So definition of capital structure is capital structure refers to the proportion of long-term funding sourced from debt, that is called as borrowed funds, and equity, that is the owner's fund. So debt includes typically the long-term loans, bonds, debentures, etc. and equity includes common shares, preferred shares and retained earnings. The importance of capital structure is a balanced structure reduces financial risks, optimizes the cost of capital, enhances investors' confidence and long-term sustainability. So this is what has been dealt in question and answer 1 of short question and answer. In short question and answer 2, the concept that has been dealt with is about debt ratio and firm's ability to raise debt. So debt ratio, again we have elaborately seen while I was taking you through the chapter, and in that the debt ratio measures the proportion of assets financed by debt per se, and the formula that is normally used as a ratio to calculate is total debt divided by total assets. So how much of assets are financed by debt, that's the purpose of debt ratio. Interpretation wise, higher the ratio, more risk, because reliance is then on borrowed funds, reduced capacity to make more, to take more loans. So because a lot of loans have been taken already for the assets, therefore the borrowing capacity in a way has got reduced, so there is reduction in the capacity to take more loans. Low ratio indicates financial strength and room for more debt. So that's another aspect of low ratio. So low ratio of debt will be that the company or the business organization more financially strong, and therefore there is a room for more debt to borrow. Impact on borrowing, the firm with a high debt ratio may face higher interest rates or loan rejections due to perceived risk. Then comes the short question and answer 3, which is dealing about debt service coverage ratio, that is DSCR in short called as. So DSCR is an indicator of a company's ability to pay debt obligations using its operating income. Formula wise, it's EBIT, that is earnings before interest and tax, divided by debt obligations due within a year, that is short term obligations. So EBIT is earnings before interest and tax, that is in a way, because earnings before interest and taxes are the measures of core profitability. The debt obligations include principal repayments, interest payments and leases due within a year. The importance of DSCR is that if the DSCR ratio per se is more than 1, then it is a safe zone for lenders, and if DSCR is less than 1, then it indicates potential cash flow problems or chances of default on the obligation. So default risk is associated if the DSCR is less than 1. In short question and answer 4, operating cash flow to net sales ratio has been discussed. Over there, the operating cash flow typically means the cash generated from the core business operations, and net sales are the total revenues from sales after returns, that is sales returns and allowances, that is discount. So operating cash flow divided by net sales ratio. So formula per se is operating cash flow divided by revenue into 100, and this indicates how efficiently a company converts sales into cash. A higher ratio reflects strong cash management and operational efficiency. So in a way, more cash sales are happening, and hence there is no risk of non-recoverability or non-receivability of the credit sales. So that's what in a way the operating cash flow to net sales ratio is all about. Then short question and answer 5 dealt with debt equity ratio algorithm. So debt equity ratio algorithm in a way compares a company's debt to its shareholders equity, how they are relating to each other, how much is the proportion between debt and equity is what the ratio tells. So formula again over here is total debt divided by shareholders equity. Algorithm logic is that inputs are the debt and equity, prevent division by 0, and output by ratio which indicates average leverage level. So over here, how much in proportion of equity is the debt is what the calculation is thrown up by this debt equity ratio. And interpretation wise, lower ratio means conservative financing and higher ratio means aggressive, potentially risky financing. Then question and answer 6 deals with credit analysis. Credit analysis is the evaluation of a borrower's ability to repay a loan, and the process that is included in credit analysis is the management evaluation as to how good the financial position is in terms of repayment of a loan. And financial statement analysis in a way includes is covered in the credit analysis, which is more of profit and loss, balance sheet and cash flow. Credit scores and ratings are given in terms of how the profile of a particular borrower is, and for example CIBIL score in India is considered as the credit scores and ratings given by RBI also. And the purpose over here of this credit analysis is to help lenders avoid defaults and reduce the credit risk. So in a way it gives a comfort to the lender in terms of the borrower's credibility to repay the obligation. Then in question and answer 7, short question and answer 7, high capitalization ratio and equity cushion has been discussed. So the capitalization ratio in a way is total debt divided by debt plus equity, measures how much of a firm's capital is debt financed, and in a way it shows the mix of the capital structure. And equity cushion is the buffer equity provides to absorb losses and protect creditors. So the buffer equity provides to absorb losses and protect creditors in a way. Implications of high ratio, so high risk of default. If the ratio is higher, then there is a debt component is higher in a way, and hence there is a high risk of default, less financial flexibility, lower ability to raise more funds, but debt is cheaper than equity, therefore tax deductible interest, so it can boost returns if managed well. That's what the equity cushion is provided with, and the implication of high capitalization ratio is what was discussed in short question and answer 7. Then in short question and answer 8, cash is king, financial health in a way was the statement which is discussed. And over here cash flow is the actual movement of cash in and out of the business. So net of cash inflow minus cash outflow is what the actual cash flow is all about. Importance over profit. A profitable company can still fail without enough cash to pay the obligations. Uses of cash, pay expenses and debts, reinvest in operations, distribute dividends, act as a buffer during downturns. So the phrase meaning of cash is king means it highlights the liquidity as a survival and growth factor. That's what the meaning is of what you can say, the statement as cash is king, financial health. Hello Rakesh, I guess you are able to see and hear the presentation. Hello Rakesh, so are you able to see the presentation and hear me also? Fine, must be if That's anyway, I'll continue with my session. Then comes the long question and answer one, which discussed about capital structure analysis, the concept and significance. So objective wise, the whole purpose of capital structure analysis is to find the optimal mix of debt and equity, and the significance of capital structure analysis is to ensure sustainable growth, minimize the cost of capital, reflects risk appetite, and helps in financial planning and investment decisions. So this is the concept that is being discussed in the long question and answer 1, which is about capital structure analysis. Then in long question and answer 2, the debt ratio and the debt equity ratio calculation has been discussed. So here debt ratio is equal to total debts divided by total assets. It indicates how much of assets are financed by debt, and therefore the in a way reflection is about the borrowings that have been made to purchase the assets. And the debt equity ratio is equal to total debt divided by shareholders equity, which measures how leveraged a company is. The purpose of these ratios is to assess financial leverage and stability as such of the business organization. So these are the concepts which were discussed in the long question and answer 2. Now moving ahead with the long question and answer 3, it has dealt with the concept of credit analysis. Hypothetical scenario has been mentioned over there, and due diligence is required to be considered. So evaluating management credibility and governance, document collection, so includes tax returns, credit history, and the business plans. Credit scores and ratings, so reflect borrower's credit worthiness, and DSCR usage, so it measures the repayment ability of the organization. So lower the DSR, high credit risk is reflected or interpreted by the ratio of DSCR. So that's what the concept of credit analysis has been discussed in long question and answer 3. Then in long question and answer 4, the DSCR calculation example has been given. So a bit over here is the proxy for available cash to pay debt. Debt obligations means short term and current portion of the long term debt. Calculation wise insights, if at all one has to drive, is DSCR is equal to 5 lakh divided by 25,000, that is 20 times. So it means that the company can cover its obligations 20 times. So it in a way has a very healthy position. So this was the DSCR concept that was discussed in long question and answer number 4. In long question and answer number 5, again cash is king, how it is relevant in cash flow analysis was discussed. So cash flow analysis wise focuses on actual liquidity, not just profit on paper, and therefore cash flow in a way is very critical and not just profit and loss, because how much cash is getting generated, that gets reflected through cash flow analysis. And therefore the importance of cash flow analysis in a way is to prevent insolvency, reflect operational strength, essential for investment and emergency management. And relevance wise, why it is very critical and relevant, it's a more reliable indicator of financial health than profit figures. So in long question and answer 6, the concept that is being discussed in the study material is high operating cash flow divided by net sales ratio. So this ratio is an efficiency indicator, shows how well sales are converted into real cash. High ratio means strong cost control, effective collection practices, and healthy core operations. Why positive? So why this ratio should be always positive? In a way, cash is essential for day-to-day operations, growth, and investors' confidence. So these are the question and answer which were left out in my previous session. Not left out, I would say, because of the shortage of time I could not cover up. So I thought I'll start today's session with completing that particular chapter's question and answers. So I have just walked you through the various concepts that were discussed in the short question and answer 1 to 6. So in a way, capital structure definition and importance, then we saw debt ratio and firm's ability to raise debt, then debt service coverage ratio, then operating cash flow to net sales ratio, debt equity ratio algorithm we saw, then we saw how credit analysis process is all about and the purpose of it, high capitalization ratio and equity cushion that is available. And cash is king, what that exactly the statement means in terms of financial health, that was also considered. Then in long question and answer we covered the capital structure analysis concept and significance. Debt ratio and debt equity ratio calculations, we saw how the formula is. Then came the credit analysis hypothetical scenario, so where due diligence, document collection, credit scores and ratings and DSCR usage was discussed. DSCR calculation example also we have covered, so EBIT and debt obligations, and then typical calculation of DSCR whereby 5 lakhs divided by 20,000 is equal to 20 times, means the company can cover its obligations 20 times and therefore it indicates a very healthy position. Question 5th deals with cash is king, relevance to cash flow inflow analysis. So cash flow analysis we dealt with, and the importance of cash flow analysis and relevance being more reliable indicator of financial health than just the profit figures. 6th question dealt with high operating cash flow and net sales ratio. So if we, in a way it's a efficiency indicator. High ratio means strong cost control, effective collection practices and healthy core operations. It should be positive. Why positive? Because cash is essential for day-to-day operations, growth and investors' confidence. So with this we end the previous chapter per se, which is about financial statement analysis. Yeah. And now the 6th chapter in the module 5 I'll be taking up. So give me just 2 minutes to switch to that PowerPoint presentation. Yeah. So in a way we are on the module 5 of fundamentals of business valuations, wherein we have covered already the purpose of business valuation, valuation premise, valuation approaches, fundamentals of valuation, how risk and return matters most in valuation. Then we just finished with the financial statement analysis, and now we will see another aspect of fundamentals of business valuation, which is the market value and enterprise value. So Rakesh, can you just confirm, are you able to see and hear me also, Mr. Rakesh? Hello, Mr. Rakesh, are you able to see the presentation? Fine. No response, but I'll continue assuming that it's happening because I can't do much anything about it. So we'll start with the 6th chapter of module 5, which is about market value and enterprise value, what it means. So typically market value, let's understand what is meant by market value. Market value is the estimated price at which an asset or liability would trade between the willing buyer and seller in an arm's length transaction. So there is no favorable considerations per se. It is dealt with in arm's length way after adequate marketing and where both parties act knowledgeably, prudently and without any compulsion. So it's a free trade whereby the buying and selling, buyer and seller comes together at a arm's length transaction takes place. So the key concepts in this definition is first, estimated amount. So the most probable market price excluding special terms that may be agreed between the buyers and seller is what the estimated amount means. Should exchange means value is an estimate, not the actual sale price, because market value in a way is more of an estimation and not the actual sale price. Therefore, should exchange is what the word being used. Valuation date means value is specific to a particular point in time. That's why it's a valuation date on which the particular valuation is being done. Willing buyer and seller means motivated but not forced, acting in line with the market conditions. That's what it means. Arm's length transactions again in the definition means between unrelated. So both the buyer and seller are unrelated to each other, not really known to each other, and therefore independent parties who take their independent decision with knowledge, prudence and without any compulsion or force enforcement. Proper marketing means sufficient market exposure before valuation. So sufficient market exposure is being done about the particular trade or the value which is being determined of the asset or the business. So sufficient market exposure before valuation, and knowledgeable and prudent means parties are well informed and acting reasonably, and without compulsion means no party is under pressure to transact or buy or sell. That's what the whole concepts, key concepts are defined in or covered in the market value definition. Then comes the second concept. Again, this chapter per se, if you see in the study material, is a very short chapter, and therefore not much to be really explained out. It's just as normally in common parlance what is understood as market value, obviously with the buyer and seller not being related, and therefore particular transaction estimated amount is done on the basis of arm's length principle, and in this case the buyer and seller are willing to enter into the particular transaction is what fetches the market value. Then comes the second concept which is discussed in the chapter, is about the enterprise value. So let's understand enterprise value. Definition: enterprise value measures a firm's total value including the entire market value rather than just equity value. It accounts for all claims and ownership interest arising from debt and equity. So that's what it means. The purpose of enterprise value being arrived at is EV represents the actual cost of purchasing a company and its theoretical price before a takeover. It is the minimum value an entity would pay to acquire a company. One. So that's what it means. Typically, this enterprise value is calculated in mergers and acquisitions. In hypothetical acquisitions, the acquirer pays the enterprise value but gains access to the target company's cash. Therefore, cash and cash equivalents are subtracted when calculating EV, and therefore EV wise the enterprise value is equal to market capitalization plus market value of debt minus cash and cash equivalents. Again, second way of calculating enterprise value is equal to common shares plus preferred shares plus minority interest, summation of that divided plus market value of debt minus cash. So this is how enterprise value is calculated. Now the key components of enterprise value, let's understand. One is the equity value. So just a second. So each term that is used in the formula for arriving at an enterprise value is discussed over here. Yeah, so the key components of enterprise values are equity value, which means the market value of shares including dilutive securities. Preferred stock means treated as debt due to fixed dividends and priority. Total debt includes all interest bearing liabilities adjusted for cash, and minority interest is the portion of subsidiaries not owned by the parent, and cash equivalents are subtracted as they reduce the study material, and the case study summary in a way is what I am trying to explain in these slides. So company A is employment services firm with no debt and mainly intangible assets. So the appropriate valuation model that will be used or should be used the free cash flow to the firm, that is FCFF, due to irregular dividends and intangible heavy structure. And company B is a conglomerate with operations in tobacco, shipbuilding and aerospace. It pays regular dividends from its tobacco segment. The appropriate valuation model would be sum of the parts due to unrelated business segments, because no operations which are there, the business operations are similar and they are totally digressive and unrelated to each other, tobacco, shipbuilding and aerospace, and hence the appropriate valuation method will be sum of the parts, because all the segments, business segments are unrelated. Now typically in such case, acquisition of company X by company B, acquiring 70% of shares, a controlling stake, appropriate consideration will be control premium. So control premium is the method that should be considered for the acquisition. So the valuer in this particular case study approach is, that is Mr. Das approach is, demonstrated strong due diligence but missed macroeconomic analysis, a part of a top-down valuation approach. So with this, in a way, we conclude the chapter 6 also. I'll just recap. So we covered the market value. So market value is the estimated price at which an asset or liability would trade between a willing buyer and seller in an arm's length transaction after adequate marketing, and where both parties act knowledgeably, prudently and without compulsion. So the key concepts in the definition are estimated amount, which is the most probable market price excluding special terms, should exchange. So because this value is an estimate, not the actual sale price. Valuation date is, value is specific to a point in time. Willing buyer and seller, motivated but not forced, acting in line with market conditions. Arm's length transaction because it's between unrelated and independent parties. Proper marketing, sufficient market exposure before valuation. Knowledgeable and prudent, parties are informed and acting reasonably. And another concept that is being discussed is without compulsion. So here no party is under pressure to transact. That's what the concept of market value is. Then we saw the enterprise value, which definition wise enterprise value means measures a firm's total value including the entire market value rather than just equity value. It accounts for all claims and ownership interests arising from debt and equity. The purpose of enterprise value represents the actual cost of purchasing a company or its theoretical price before a takeover. It is the minimum value of an entity would pay to acquire a company. Mergers and acquisitions. In hypothetical acquisitions, the acquirer pays the enterprise value but gains access to the target company's cash. Therefore, cash and cash equivalents are subtracted when calculating enterprise value. And enterprise value formula wise is market capitalization plus market value of debt minus cash, or else otherwise enterprise value is equal to common shares, that is equity shares plus preferred shares plus minority interest plus market value of debt minus cash. And the key components we saw: equity value means the market value of shares including dilutive securities. Preferred stock treated as debt due to fixed dividends and priority. Total debt includes all interest bearing liabilities adjusted for cash. Minority interest is the portion of subsidiaries not owned by the parent. And cash equivalents are subtracted as they reduce the acquisition cost. Then we saw the significance of enterprise value. It reflects the true economic value of a company, useful for comparing companies with different capital structures. It represents the theoretical takeover price and helps mitigate market volatility risks in valuation comparisons. Company A, then there was this case study which is covered in the syllabus. Company A is a employment services firm with no debt and mainly intangible assets. And for such company, the appropriate valuation model which is suggested in the by the case study or in the case study by the institute's material is that of free cash flow to the firm, that is FCFA, due to irregular dividends and intangible heavy structure. Then there is a case study in the case study company B, which is a conglomerate with operations in tobacco, shipbuilding and aerospace. So with such diversified and unrelated business segments, which also pay regular dividends from its tobacco segment, the appropriate valuation model will be sum of the parts, that is due to unrelated business segments. The acquisition of company X by company B, acquiring 70% of shares, a controlling stake. The appropriate consideration will be control premium, and premium being paid for the control, which is like 70% controlling stake, and therefore the premium is being paid for that controlling interest. So Mr. Das, who is the valuer in this particular case study, approach reflects or demonstrates strong due diligence but has missed macroeconomic analysis, a part of a top-down valuation approach. So with this, in a way, we conclude the chapter 6 of the module 5, and in a way, in terms of the weightage, obviously the whole concept has a small weightage of percentage. So the whole module of fundamentals of business valuation is of 5% weightage, but in terms of complying with the or covering the entire syllabus for the students' benefit of this particular subject, that is paper 20A, strategic performance management and business valuation. In a way, with this conclusion of module 5, we have covered almost 55% of the weightage portion of the entire syllabus. So thereafter it is the module 6 which is to be looked upon at, and this module 6 in a way will be covered up in the next session. How much is the time? Yeah, okay. So we will cover up in the today's session only, and therefore let's see what is there in module 6 per se. So give me 2 minutes, I will switch over to the next module. Yeah. Yeah, sorry, just a second. So again, this module is a 5% weightage that has been given in this module. Module 6, which is about laws and compliance in business valuations. So we'll see the regulatory framework which mandates the business valuation, how it should be done, and where all, under which all acts or provisions the business valuation is required to be done. And in this, there are 5 chapters which talks about salient features of insolvency and bankruptcy code, that is IBC 2016. The Companies Act 2013, that is certain sections which deals with business valuation, that will be covered in the next chapter. The third chapter is about salient features of companies, registered valuers and valuation rules. So again, there are specific rules about how the valuation should be done and who should be the valuer, etc. So those we will see in this companies, registered valuers and valuation rules 2017. Salient features of SURFACE Act Act 2002 on valuation, and then lastly, fifth chapter talks about valuation standards. That is the International Valuation Standards Council, IVSC. So to begin with, let's see the salient features of Insolvency and Bankruptcy Code 2016. So to introduce to this Insolvency and Bankruptcy Code 2016, majorly businesses may shut down due to economic downturns. So because businesses at times have to function in certain volatile, unambiguous, VUCA, uncertain, ambiguous and complex environment, at times the businesses may get forced to shut down due to economic downturns, business failure or poor management by itself. Failure in business should not carry stigma, so system should support dignified exit also, and therefore no matter even if the business is failed, that doesn't mean some kind of a bad social status has happened, and therefore exit there should be an honorable exit in a way. And since system should support the economic systems, ecosystem should support dignified exit, therefore a strong solvency and bankruptcy framework was vital for a healthy business ecosystem, and that's where IBC, that is Insolvency and Bankruptcy Code, came into existence in India's mechanism to handle debt defaults for companies, LLPs, firms and individuals, not financial service providers unless notified. And insolvency, typically, let's understand what this, give me a minute. So what is meant by insolvency and what is meant by bankruptcy is in a way defined. Yeah, so insolvency is the inability to repay debts over time, may lead to asset sale or restructuring. Now over here typically bankruptcy also means voluntary declaration of insolvency by the promoters, and of course the court driven asset liquidation to settle debts. So voluntary declaration of insolvency before the court of law, and therefore the court the liquidation of assets is done through court driven process, and thereby the debts are settled. So the objective of the code, let's understand the salient features. We are understanding the salient features of IBC. So objective of the code is to consolidate various insolvency laws which were there prevalent prior to 2016 into a single legislation, that is IBC. So that's called as IBC 2016. So in the year 2016, this IBC code was made effective. It ensured time-bound reorganization and resolution to maximize the asset value. It separates commercial and judicial aspects of insolvency and introduces a fast-track resolution for corporates and LLPs. So 90 days plus 45 days extension for SMEs and startups is the kind of fast-trackness that has been brought into such major corporate action of insolvency and bankruptcy situations. So these are the objectives of the IBC code per se. In this, the salient feature is the overall process that has been defined is about the insolvency resolution process. Now in short, it is popularly known as the IRP. So it is initiated by debtor or creditor via an insolvency resolution professional. So IRP. So IRP is insolvency resolution professional. Partners in firms need majority consent to file, and corporate solvency resolution process, that is CIRP, can be initiated by financial creditor, operational creditor or the corporate debtor itself, means the company itself. So minimum default threshold is of rupees 1 crore. The timeline that has been set for such insolvency resolution process is 180 days, extendable by 90 days with some 66% creditors committee of creditors approval, that is COC. Resolution plan may involve restructuring. So over here this restructuring may involve merger, demerger, etc. And then the interim resolution professional, that is IRP, takes over management and preserves the value. So this is how insolvency resolution process is carried out, and these are the characteristics of IRP as such. So this is the diagrammatic presentation of the whole process of insolvency resolution process, and this diagram has been picked up from the study material itself, because I felt there is no need to reinvent the wheel, and the elaborate pictorial representation of the process has been already done by the study material. Therefore the default by corporate debtor, so a company defaults, thereafter application with adjudicating authority, appointment of an IRP, that is interim resolution professional, then remuneration of committee of creditors, appointment of valuers is to be done, thereafter preparation of information memorandum by resolution professional, the resolution plan proposed by the creditors, committee of creditors, which thereafter presents a plan. So if the plan is approved by COC with at least 75% of the majority, then as per resolution plan example, sell as going concern, or then the second option is to liquidate the corporate debtor. So if at all liquidation happens, then it is initiated if no resolution plan within IRP timeline is submitted and the creditors and the committee of creditors opts for liquidation, then resolution plan is violated or rejected. So NCLT thereafter orders liquidation. So in a way the elaborate process is not required or is not covered in the study material also. Whatever that has been covered in the study material, these pointers are in a way summarized pointers of the entire concept which has been explained of the IBC code as salient features of the IBC code in the chapter, which I have in a way concise and crisp summary way I have tried to explain it out and mention it out over. So this will help you for your exam preparations also. As long as you get to know the real summarized pointers of the concept as such of liquidation, one will be easily able to understand and write the question paper, answer papers as such. So NCLT orders liquidation and makes public announcement in the local newspaper as mandated by the IBC code, and thereby notifies the registration authority. And once the NCLT order is passed, the interim resolution professional becomes a liquidator unless replaced by NCLT itself. So in a way NCLT appoints the interim resolution professional who in a way administers the entire liquidation process on behalf of the corporate debtor and the NCLT also. And therefore unless the NCLT replaces itself with this IRP, until then the IRP becomes a liquidator. The continuing the liquidation process begins with winding up order passed by the NCLT and ends with the company dissolution. So liquidator in a way realizes the assets and distributes the proceeds after distributes the sale proceeds of the assets as per section 53, and the order of priority of distribution is prescribed in the IBC code 2016, and the following is the order of priority in distribution, that is IRP and liquidation cost is first to be settled. Thereafter secured creditors who relinquish their rights and 24-month workman dues. The third priority is given to the employees' wages of 12 months. Fourth is unsecured creditors. Fifth are the statutory dues and unpaid secured creditor debts. Sixth is other debts and dues. Seventh will be the preference shareholders, and eighth, that is the last in the priority, is the equity shareholders or the partners of LLP in case of LLP. So in liquidation again there is this process of voluntary liquidation allowed if company has no debts or can repay fully, not being liquidated for fraudulently, and requires declaration of solvency by majority directors. So in a way there are no debts and or can repay the debts fully because there are sufficient assets. In such situation, voluntary liquidation is allowed only. Then in the IBC code again, the another concept that has been discussed is about the regulations pertaining to valuer. Who can be a valuer? So this under the IBC code, the registered valuer who will value the assets to be realized and accordingly to use that proceeds to pay off the debts. That such registered valuer should be as per the Companies Act 2013. The interim resolution professional must appoint 2 registered valuers within 7 days to estimate liquidation value. The liquidation value per se is calculated or arrived at as per the regulation 35 of this IBC code 2016, and this liquidation value includes estimated asset value if liquidated on insolvency commencement date, or it could, the values provide estimates based on international standards and physical verification. If 2 estimates vary significantly, a third valuer may be appointed, and the final value will be the average of the 2 closest estimates. Then the asset valuation in liquidations. So as 2 valuers appointed to independently estimate realizable asset value. So in case of voluntary liquidation, section 59(3) requires director's declaration of solvency. So these are the procedural aspects that one has to follow under the IBC 2016. So in a way we are discussing the regulations pertaining to valuer, and therefore in event of voluntary liquidation decided by the committee of creditors, then certain compliances are expected, which is the director's declaration of solvency, and secondly the valuation report by a registered valuer, if prepared, has to be submitted. Now over here the final report which is required to be given in section 38(1)(c) deals with the voluntary liquidation regulation again. Now this final report includes realized value of assets, the cost and method of sale, the reason for shortfall versus valuation, the buyer details, other sale related details. So this is what is covered in the final report that is issued in voluntary liquidation, which is covered in the regulation 38(1) sub regulation 1 sub regulation C. So that is called as regulation 38(1)(c), which in a way mandates what sort of data or how the final report of is to be issued by the valuer appointed under the IBC code in voluntary liquidation. Now let's speak up again. As I said, this is again a very short because the overall weightage, if you see, is 5% only in terms of 100 marks paper, and therefore there will be some kind of a short concept that has been dealt with in this module 6 also, being the entire regulatory and legal framework built around the business valuation. So now let's, so with this in a way the theoretical portion is completed for this particular chapter, which is about salient features of the Insolvency and Bankruptcy Code 2016. Now in the study material again there are various short question and answer and long question and answer. So as my practice had been for this subject per se, I am taking up the various concepts that have been discussed in the short question and answer one by one. So in short question answer number 1, the concept that has been discussed is the objective of the Insolvency and Bankruptcy Code. What are the objectives? Why the IBC came into existence? So first and foremost, it came into existence to consolidate laws relating to insolvency of companies and LLPs. It ensures time-bound. It came into existence to ensure time-bound resolution and reorganization of the corporate debtor who is in a way considered to be insolvent. It separates commercial decisions from the judicial processes, and the overall purpose or the objective of this IBC is to provide a unified and efficient legal framework for resolving insolvency in a timely and orderly manner. So this is the purpose or the objective of the IBC, which is dealt in short question and answer 1. In short question and answer 2, the insolvency resolution process, again IRP has been discussed. or has been covered. So this IRP can be initiated by debtor, creditor or the insolvency professional himself. So there is an interim resolution professional who takes over the management and is appointed. The objective of this IRP is to preserve asset value and adopt resolution plan within 180 days. The whole IRP process is to a structured mechanism to revive an insolvent entity through stakeholder driven resolution within a defined time frame, which is of 180 days. So that's how the purpose of IRP process or the actual IRP process is as such, which is discussed in short question and answer 2. In short question and answer 3, the liquidation process under IBC has been discussed. So this liquidation process starts with winding up order and ends with the dissolution per se. So liquidator, which is appointed by NCLT, manages the asset realization and the distribution of these sales proceeds of the assets being realized amongst the order of preference or the order of priority of the distribution that has been prescribed under the IBC. So it follows a priority order for distributing the proceeds realized from the assets that are being sold as a part of liquidation process. A final recourse to realize and redistribute and distribute the value of the insolvent entity's assets when resolution fails. So that's the whole purpose of this liquidation process under IBC. Then in question and answer number 4, short question 4, the role of registered valuer has been discussed. Now typically the role of registered valuer is to estimate realizable value of assets. He conducts the physical verification of the assets. He uses internationally accepted valuation standards to value the assets and thereupon arrive at the realizable value of the asset. And the whole role of the registered value is to provide a fair and objective basis for asset valuation, which is very critical to the both resolution of the insolvency as well as liquidation stages also. Then short question and answer 5 has discussed the voluntary liquidation. So voluntary liquidation includes or is initiated by solvent companies or LLPs. Directors must, as a part of documentation, declare solvency through affidavit. Debt must be paid or be payable from assets proceeds. An orderly exit mechanism for solvent entities choosing to wind up operations voluntarily. So this is how the voluntary liquidation process is conducted, or the key features of voluntary liquidation process is all about. In short question and answer 6, the concept that has been discussed is the distinction between insolvency and bankruptcy. Most of the times the words are interchangeably used, but they have a significant differential meaning. So insolvency in a way is inability to pay debts. So inability to pay debts is basically insolvency, and bankruptcy is the legal declaration of insolvency by a court. So it's a next step of the legal declaration per se of insolvency is bankruptcy, whereas insolvency per se means the inability to pay the debts. So in a way, bankruptcy leads to court monitored asset liquidation process. Insolvency is a financial condition, whereas bankruptcy is a legal status initiated due to insolvency. So these are the two distinctive aspects of insolvency and bankruptcy, and they are not interchangeable. But bankruptcy is the legal declaration of insolvency in a way. Then short question and answer number 7 has discussed the role of interim resolution plan or IRP. So in a way, IRP role is to take over management after initiation of the IRP, that is interim resolution process. He preserves value and manages company as going concern. He acts under the supervision of committee of creditors. The IRP is nothing but a custodian who ensures operational continuity and asset preservation during insolvency proceedings. So he has a big role to play in the overall insolvency and bankruptcy scheme of things, and therefore IRP in a way is the custodian of the entire operational continuity and asset preservation during the insolvency proceedings. Then in short question and answer 8, the question that has been dealt is whether can a corporate debtor itself declare bankruptcy? Yes, it's a voluntary kind of a disclosure then or declaration via corporate insolvency resolution process, that is CIRP. A corporate debtor can declare himself or itself as the bankrupt. So the resolution process lasts for 180 days. Failure to adopt a plan leads to liquidation. So if the particular insolvency resolution process is not being adopted and the plan fails, then it may lead to liquidation. So CIRP in a way enables corporate debtors to voluntarily seek resolution or liquidation through the legal provisions of the IBC 2016. Then now let's see the long question and answers, what concepts they have dealt with. So long question and answer number 1 has dealt with what is insolvency and how is it resolved. So in a way the insolvency, as we know, is the inability to pay debt over a period of time. It is resolved via restructuring, legal action or asset sale. It may involve negotiation or court-led proceedings as well, and a financial condition requiring strategic resolution to protect creditors' interest and potentially revive the debtors. So this is how the insolvency, what insolvency means and how it can be resolved. That is being dealt in long question and answer 1. Then let's see what is covered in long question and answer 2. It deals with the objective of IBC in India. So why IBC came into existence, that has been discussed. So unified insolvency framework was being adopted through IBC. A time-bound asset maximization processes were defined. It differentiated commercial and judicial aspects, and a robust legal tool was the need of the hour to ensure efficient insolvency handling, protecting the creditor's right and enhancing the business confidence. So these were the objectives of IBC in India, which is dealt in long question and answer 2. Then in long question and answer 3, initiation of the insolvency resolution process, how it can be initiated, the insolvency resolution process, and who can initiate the process. It can be initiated by debtor, creditor or the insolvency professional. Partners in firms or directors of the companies need to give majority consent, and the process involves NCLT admission and appointment of IRP, that is the insolvency resolution professional. It is inclusive it includes initiation system allowing multiple stakeholders to trigger the insolvency mechanisms. In question and answer, long question and answer 4, no consensus if at all are reached on resolution plan, then what happens is dealt. So the creditors of committee of creditors, that is COC, decides on liquidation. NCLT and submits a plan to NCLT. NCLT can reject the unworkable plans. Upon rejection, non-compliance with plan also triggers liquidation in a way. When consensus fails, IBC ensures timely exit through liquidation to protect the value of the assets. Then long question and answer 5 in a way dealt or deals with the determination of liquidation value. How liquidation value is to be determined. The two registered valuers assess value post verification. A third valuer may be appointed if significant difference is there between the two values determined by the two registered valuers which have been appointed by the IRP. Average of the closest two used as final value if there is a difference in the valuation that has been done by the registered valuers. So this liquidation value process in a way ensures fair verified estimation of the asset value, forming basis for resolution or liquidation plans. Then long question and answer 6, which is the significance of registered valuer, which is being discussed in this long question and answer 6. So significance of registered valuer is that critical in determining fair market and liquidation values, basis for resolution planning and creditors payout, adheres to global standards and verification norms. Valuers are central to maintaining objectivity and transparency in financial assessments during insolvency proceedings. So this is the importance of registered valuer as such in the whole IBSE proceedings, whether it's insolvency or bankruptcy also for that matter. And with this, in a way, we conclude the chapter 1 of the module 6, which talks about the salient features of insolvency and bankruptcy code 2016. I will do a recap of the entire chapter now in a quick way. So in today's session, after the conclusion of the salient features of after concluding the short and long question and answers of the chapter of financial statement analysis, and thereafter the market value and enterprise value of module 5, the last two chapters in a way, we started with the module 6, which is talking about the laws, the legal and the regulatory framework around the business valuation. And in that chapter 1 is talking about salient features of the insolvency and bankruptcy code. So in this session we covered the whole purpose of and got introduced to the IBC. So businesses may shut down due to economic downturns, business failure or poor management. Failure in business should not carry stigma, and ecosystem should support dignified exit, honorable exit. A strong insolvency and bankruptcy framework is vital for a healthy business ecosystem. And IBC, in a way, code came into existence. So IBC, that is the insolvency and bankruptcy code in existence, is India's mechanism to handle debt defaults for companies, LLPs, firms, individuals. Of course, doesn't include financial service providers unless notified by the appropriate authority. So let's understand, and then we understood insolvency means and bankruptcy are two separate meaningful words under the IBC. And IBC, in a way, insolvency means inability to repay debts over a time and may lead to asset sale or restructuring of the debts also. And bankruptcy is the voluntary declaration of insolvency, which such declaration is required to be filed with the court of law, and thereafter if the NCLT approves that, the court driven asset liquidation happens to settle the debts with a particular priority. Light And bankruptcy typically is the voluntary declaration of insolvency, and thereafter the NCLT, that is court driven asset liquidation process, starts to settle the debts in a particular order of priority. Then we saw the objective of the code. Objective of the code is to consolidate various insolvency laws into a single legislation, that is IBC 2016. It ensured time bound reorganization and resolution to maximize the asset values. It is separate process. The whole purpose of IBC is to separate commercial and judicial aspects of insolvency and introduce the fast track resolution for corporates and LLPs. Otherwise, in the earlier regime or the various legislations which were there, or I would say diversified legislations which were there about insolvency and bankruptcy, the whole process was a big long drawn process and used to continue over a longer period of duration. Now under IBC has introduced fast track resolution for corporates and LLPs, so it's 90 days plus 45 days extension for SMEs and startups. Then we covered the overall insolvency resolution process, IRP. Now this IRP can be initiated by a debtor or a creditor via an insolvency resolution professional. So insolvency resolution professional is appointed, and thereby debtor and creditor can initiate the insolvency resolution process. So partners in firms or directors needs majority consent to file. Corporate insolvency resolution process, that is CIRP, can be initiated by either a financial creditor or a operational creditor or the corporate debtor itself. So minimum default threshold is 1 crore, and the timeline of the process is 180 days, extendable by 90 days with 66% of the committee of creditors approval. Resolution plan may involve restructuring, merger, demerger, etc., which may be proposed by the IRP, that is the insolvency resolution professional. And this interim resolution professional takes over the management and preserves the value of the assets. This is the overall IRP process. So default by corporate debtor, application with adjudicating authority, thereafter appointment of the interim resolution professional, IRP. Then comes the formation of committee of creditors, that is COC. Appointment of valuers are done. Thereafter preparation of information memorandum by resolution professional, and the resolution plan that is proposed by COC is presented. Now this plan approved by COC with at least 75% of majority. Then as per resolution plan, example, sale as going concern or else liquidation per se will have to be done. So then we went through the liquidation process. It can be initiated by no resolution plan within IRP timeline, if at all can be provided with, and then in that case the committee of creditors opts for liquidation. The resolution plan in a way is violated or rejected. NCLT orders liquidation, makes public announcement and notifies registration authority. IRP becomes liquidator unless replaced by NCLT. The liquidation process begins with winding order of the NCLT and ends up with the liquidation with the company dissolution. Over here, as per the section 53, liquidator realizes assets and distributes the proceeds as per the regulation or section 53. So in this IBC regulation, the order of priority in distribution has been prescribed. Accordingly, the proceeds of the assets realized should be distributed or used to settle the debts, and this order is as follows. The interim resolution professional will and the liquidation cost will be borne first, then secured creditors who relinquish the rights and 24-month workman dues. Third is the employees' wages of 12 months. Fourth is the unsecured creditors. Fifth priority is given to the statutory dues and unpaid secured creditor debts. Sixth priority is to other debts and dues. Seventh is to the preference shareholders, and eighth, which is the last in the hierarchy or priority, is the equity shareholders or the partners in case of LLPs. Then we saw the voluntary liquidation is allowed if company has no debts or can repay fully the debts. So sufficient assets are there. In such situation, voluntary liquidation is allowed. So not being liquidated fraudulently and requires declaration of solvency by majority directors. Then we saw the regulations which are in relation to the valuer. So registered valuer should be appointed as per the Companies Act 2013. IRP must appoint 2 registered valuers within 7 days to estimate the liquidation value. Liquidation value is the estimated asset value if liquidated on insolvency commencement date. Valuers provide estimates based on the international standards and physical verification. If 2 estimates vary significantly, then a third valuer may be appointed, and final value in such scenario will be the average of the 2 closest estimates. So asset valuation in liquidation, in a way, 2 valuers appointed to independently estimate the realizable asset value, that is called as liquidation value. Then we saw again in voluntary liquidation, section 59(3) requires director's declaration of insolvency and voluntary valuation report by a registered valuer if prepared. Then we saw how the final report should be given by the valuer and what all is to be included. So the voluntary, in case of voluntary liquidation, regulation 2017 which are prescribed under the IBC code 2016. The final report which is dealt in the regulation 38(1)(c) includes realized value of assets, cost and method of sale, reason for shortfall versus valuation, buyer details and other sale related details. Then we saw the various short question and answer, which is number one dealt with the objective of insolvency and bankruptcy code IBC. So the objective of the IBC is to consolidate law relating to insolvency of companies and LLPs. It ensures time-bound resolution and reorganization. It separates commercial decisions from the judicial processes, and the overall purpose of objective of IBC is to provide a unified and efficient legal framework for resolving the insolvency in a timely and orderly manner. So in a way I am recapping the entire session again because we have sufficient time still to conclude the session, and there we saw through the short question and answer 2, which is about insolvency resolution process. It can be initiated by debtor, creditor or via insolvency professional. Interim resolution professional, that is IRP, takes over the management. The objective is to preserve asset value and adopt resolution plan within 180 days. A structured mechanism to revive an insolvent entity through stakeholder driven resolution within a defined time frame. Then short question and answer 3 dealt with the liquidation process under IBC. So liquidation process starts with the winding up order and ends with the dissolution. The liquidator appointed to manage asset realization and distribution. It follows a priority order for distributing proceeds. A final recourse to realize and distribute the value of the insolvent entity's assets when resolution fails. The short question and answer 4 in a way dealt with the role of registered valuer. So the role of registered valuer is to estimate realizable value of assets, conduct physical verification of the assets that are involved or available with the corporate debtor which has filed the insolvency or liquidation proceedings, uses internationally accepted valuation standards to arrive at the realizable value, and therefore it provides a fair and objective basis for asset valuation critical to both resolution and liquidation stages as such. So question number 5 dealt with voluntary liquidation. So voluntary liquidation is initiated by solvent companies or LLPs. Directors must declare solvency through affidavit. Debt must be paid or be payable from asset proceeds. An orderly exit mechanism for solvent entities choosing to wind up operations voluntarily. Question number 6, short question and answer 6 deals with insolvency versus bankruptcy. So insolvency is the inability to pay debts of an organization, and bankruptcy is the legal declaration of insolvency by a court. So in a way official or legal declaration by a court about the insolvency or inability to pay debts is bankruptcy, whereas insolvency itself is the inability to pay the debts. So in a way insolvency is the trigger for bankruptcy, and bankruptcy is a subsequent step of insolvency. Bankruptcy leads to court monitored asset liquidation. Insolvency is the financial condition and bankruptcy is the legal status initiated due to the financial condition, that is due to insolvency. The role of interim resolution professional, that is IRP, is to take over management after initiation of IRP. It preserves value and manages company as going concern. It acts under supervision of committee of creditors. The IRP is a custodian who ensures operational continuity and asset preservation during insolvency proceedings. Then short question and answer 8 dealt with the question whether a corporate debtor can declare bankruptcy itself. So the answer is yes, via corporate insolvency resolution process such a corporate debtor can declare bankruptcy. However, failure to adopt a plan leads to liquidation, and CRP in a way enables corporate debtors to voluntarily seek resolution or liquidation through legal provisions. Then we covered the long question and answer one, which dealt or which has considered what is insolvency and how it is resolved. So insolvency is the inability to repay debt over time, resolved via restructuring, legal action or asset sale. It may involve negotiation or court-led proceedings. It's a financial condition requiring strategic resolution to protect creditors' interest and potentially revive the debtors. Objective of IBC in India: unified insolvency framework, time-bound asset maximization processes, differentiates commercial and judicial aspects, and a robust mechanism legal tool to ensure efficient insolvency handling, protecting the creditor rights and enhancing the business confidence. Then long question and answer 3 dealt with initiation of the insolvency resolution process, that is IRP. It can be initiated by debtor, creditor or via insolvency professional. Partners in firms need majority consent to be given for such insolvency. Process involves NCLT admission and appointment of IRP, inclusive initiation system allowing multiple stakeholders to trigger the insolvency mechanism. Question number 4, long question and answer 4, deals with no consensus on resolution plan, then what? So if there is no consensus or resolution plan, then the committee of creditors COC decides on liquidation. NCLT can reject unworkable plans also. So non-compliance with plan also triggers liquidation, and when consensus fail, IBC ensures timely exit through liquidation to protect the value of the assets. Question number 5, long question and answer 5, dealt with determination of liquidation value. So 2 registered valuers assess value post verification. A third valuer may be appointed if significant difference is. Average of closest 2 used. Average of the closest 2 is used as final value. Just a second. And this overall liquidation value in a way ensures fair verified estimation of asset value, forming basis for resolution of liquidation plans. Question number 6, long question and answer 6, dealt with significance of registered value. The importance of overall registered value is critical in determining the fair market value and liquidation values. It forms as the basis for resolution planning and creditors payouts. The registered valuer in a way adheres to global standards and verification norms. Valuers are central to maintaining the objectivity and transparency in the financial assessments during insolvency proceedings. So with this, we end with the session and the chapter of chapter number 1, which is about the salient features of the Insolvency and Bankruptcy Code 2016. See you in the next session. Rakesh, any doubts, queries on the session so far heard and seen? Can we end the session then? Okay, fine. So we'll stop for the day, stop for the session. See you in the next session with the rest of the chapters in module 6 of module 6. Predominantly we'll cover the Companies Act 2013, which is about certain sections which are dealing with the valuations as such. So signing off here, CACS Pushkaraj Vishnu Doshi. See you in the next session.